All right, good morning or good afternoon, everyone. Donna, Casey, are you ready if we go ahead?
Totally ready.
Great. Thank you so much for joining us today for this webinar where we'll be discussing loan guarantees as a tool for economic transformation and with the help and providing the example of the work that Donna and Casey are doing and have been doing for a long time at Shared Interest. Um, and I really look forward to their presentation. As we discussed, a lot of very interesting issues came up, so much so that I was even having almost a hard time today trying to frame it briefly, as we normally do within the context of the work of the Transform Finance Investor Network. And so I decided to just highlight a couple of things before turning it over to Donna and to Casey. This idea of economic justice as an aspect of transition in a transitional society. As some of you might know, the work of Shared Interest came out of work that Donna had done in the anti-apartheid movement in South Africa, and what happened after the end of official apartheid, and the need that there was for an economic justice effort around that. And Donna will tell us a little bit of the history of how Shared Interest landed on this idea of loan guarantees as the most appropriate tool for fostering this economic justice transition. And part of what I like, as we've mentioned previously on these webinars, is this notion of loan guarantees as an alternative to some of the sexier stuff, perhaps, in impact investing and in social justice investing. The idea that sometimes we really just need to focus on the plumbing, on the tools of what it is that is going to make capital flow. And loan guarantees, again, to the extent that they help the flow of credit that otherwise would not be available, especially to traditionally underserved communities, is one of the ways that that plumbing really makes the transition to a more just economy possible. Now, as I thought of their work and the expansion that Shared Interest is now experiencing across Southern Africa and beyond, I really thought about what it would look like in the US context, for example, to have a tool of this sort, right? There are clearly undercapitalized communities. There's been a history, as there was in South Africa, of discrimination against African American borrowers. And I thought, well, in this context, really banks would have a duty to lend on the same terms. This, to some extent, as has been documented, is not happening. If loan guarantees were to be offered in this case, I started to wonder about who that subsidy would benefit. Would that go towards the banks? Would that be something more akin to the context of the Community Reinvestment Act? Or will it really be subsidy neutral in some ways and truly make more credit available to communities to whom historically it had not been, and on what terms? And the other concern that came out of last month's presentation on credit circuits and SARDEX was this concern around the financialization of the economy and the intermediation of credit that I would like for us to keep in mind as we think about loan guarantees as a way in which, in a sense, you put a buffer between creditor and borrower, and what that does to the actual healthy relationship that there ought to be between creditor and borrower. So those are really just a couple of things that were swirling through my head. As you can imagine, a lot of things have been swirling through my head this past week. So I will gladly pass it over to Donna and Casey now. Donna Katzin is the founding executive director of Shared Interest. She was previously at the ICCR, the Interfaith Center on Corporate Responsibility, as director of South Africa and of the International Justice Programs, starting in 1986. So she really brings a wealth of experience and a wealth of knowledge to her work at Shared Interest. And Casey Cline is Director of Impact Investing at Shared Interest. He comes from a background in finance, where he did investment management for 17 years at Allen and Company. And after that, at an NGO in West Africa, working with small-scale farmers. And he was also a Kiva Fellow in Central America. So it brings a very interesting international perspective to this work. So thank you so much, Donna and Casey, for joining us. I really look forward to hearing your presentation.
Thank you. Well, we are thrilled and so grateful to you for convening this conversation, Andrea, and for all of you who are with us on the webinar. Thanks for joining us. We are particularly taken with the subject of transformative finance because that is the name that we have been looking to give to the field that we are in for a number of years, and it feels as though we have finally come home in that field. Particularly at this time in history, in our history, when I would say that our mandate to build a more equitable society and a more connected and just world is stronger than ever, particularly in the last week. And so the ways in which we can connect the dots and change the systems together will strengthen all of us. What I just wanted to lay out briefly, conceptually, what we are looking at, the small piece of transformative finance that we are going to be discussing today. We'll start out with a bit of an introduction, how we got here and the context that we're part of, but we're going to be looking at two and actually three specific kinds of transformation, three dimensions of transformative finance. One is transforming the lending practices that keep people poor and powerless. That will take us to look at commercial lending institutions. Secondly, we'll be looking at the impact of those changes on excluded communities themselves and how to transform the financial options and opportunities that are available to those communities. So building skills, access to resources, and also new practices for conserving and regenerating the land. And then finally, we'll be looking at transformative partnerships, because one of the really exciting dimensions of this work is stakeholders and thought partners working together in new ways. And we want to share just a couple of examples as food for further thought. We'll then look at the impact and what is coming down the pike. So looking first at how we got to this place in transformative partnerships, let's reel back the clock to 1994, when Nelson Mandela was elected South Africa's first democratically elected president, and the struggles that had been going on for over 100 years finally bore fruit in South Africa. And what that meant was that there was majority rule for the first time. Everyone was allowed to vote. And there was tremendous political euphoria at the time that change was on the way. Around the world, the faith-based communities that had prayed, protested, and divested to strengthen a peaceful transformation, campuses and communities that had been part of that push understood their future and their own struggles reflected in the future of South Africa. And some of the people on this call, as I understand, are with institutions and movements that were part of that work. So come 1994, we are looking at, I'm at ICCR at the time, and many institutional investors who had been part of taking their money out, communities that had been part of pulling other people's money out, campuses that had been part of getting their colleges to disinvest, were now beginning to ask a different set of questions. And they were saying, we understand that the transition is not over in South Africa, that this is only the beginning. So rather than just taking our toys and going home, we would like to reinvest in a more equitable society and help accelerate the economic transformation. Archbishop Tutu said it very clearly at the time. He said the end of apartheid is part one of the struggle, but part two is the more difficult, to make the miracle endure. He said, first we asked you to disinvest. Now we say to you, invest, make South Africa succeed for the sake of the world. And so we took him literally. And we began to think about what is an investment vehicle that would make sense to help people around the world, and particularly in the US, begin to channel their funds back into a more democratic South Africa. Our investors, who were quite transformation minded, said to us, we really don't worry about the stock exchange. Others will worry about the Johannesburg Stock Exchange. For us, transformation means investing in grassroots communities, empowering those communities to drive their own development. And we began to think about ways of doing that. We could have done what a number of other funds around the world do, and that is borrow money in the United States and lend it overseas, a simple loan fund. You all are familiar with those. But we looked at the realities and we said the most impactful thing that we could think about would be if we could move South Africa's own financial institutions to lend to the 90% of the people who are financially excluded, we would, in fact, be enhancing and accelerating a greater change. At that time, 87% of South Africa's land was owned by its 13% white population. 72% of the people today in Southern Africa are still excluded from financial services and still face daunting poverty rates and economic and environmental challenges. So in 1994, when we began to look for the sectors that we would like to guarantee, where do we want to basically seed this transformation? We looked at small and growing businesses, which have such a role to play in the region as they do elsewhere, in creating jobs and generating community-based economic power, some of them in the formal sector, some in the informal sector. We looked at smallholder farmers and their cooperatives and associations, with agriculture driving so much of the production in the country and addressing needs for poverty, hunger, and an economically disenfranchised rural population. We looked at microfinance institutions, which have been very, very important in many countries. In South Africa, they're a little bit less developed than they are in some other countries, but there are a few stellar ones. And we wanted to help them grow and achieve the scale and success that would benefit so many of their borrowers. And then we looked at opportunities for low-cost social housing and providers of infrastructure, particularly that would benefit disenfranchised communities. So that took us along into the early 2000s. And by 2010, we began to ask a different set of questions as the model took off. And one of those was, what could we do to not only assist South Africa, but begin to recognize that an island of wealth in a sea of poverty is unsustainable, to say the least, and that South Africa itself could not succeed without a financially, economically vibrant region that was more equitable and more integrated. And so we began judiciously, one country at a time, to reach out to other countries. We have active guarantees as well in Swaziland and Mozambique, and initiatives that we are beginning to explore in Zambia and Malawi. And so, Casey, I'm looking to you to take us to bridging the financial gap.
Thank you. And I apologize to the group. I'm having some technical issues, so you neither have my smiling face nor can I see the slides. So Donna, thank you for moving those along. The question is, looking at this slide, is where do guarantees really fit in the array of options for SGBs or agribusinesses, MFIs, and the like. And as you see the shaded orange there, they really act as a bridge between grants and equity on the one side and access to commercial credit on the other. They also often provide an exit strategy for other impact investors when their investment is closing in on maturity. Often the business in which they've invested is not ready to access commercial credit on their own, and guarantees can fit very nicely in there to provide the support to get them financing. Um, One of the things that I think is particularly impactful about guarantees, and Donna mentioned this, and frankly we will again, because I think it's important to really hone in on this, is that guarantees unlock capital from local commercial lenders, Southern African commercial lenders, to these low income communities, and basically forcing these lenders to develop new products for these communities. So I'm going to tell you a little bit how it works on this wheel on the next slide. Um, Donna, you're able to flip that. Thank you. I know you're on mute. So the question is, how does it all work? And essentially, I'm looking at the green wedge at the top at 12 p.m. Essentially, investors will lend us money for our guarantee fund, for which they will receive a promissory note. We take this money, we invest it in high-grade securities with a large U.S. bank, Citibank, actually, with whom we've had a long-standing relationship, and we keep all that money at Citi, invested in those securities. They're the custodians of those assets. Because of that, they're able to eventually issue an LC on our behalf, a letter of credit, which I'll talk about in a second. So while that's going on in the U.S. with our investors, and we've primarily U.S. investors, but also some non-U.S. investors, while that's going on, and I'm moving to 2 p.m. in this wheel here, the lighter green wedge, we're working with our field partners. For example, in South Africa, we work with the Tembani International Guarantee Fund. They're building relationships with local commercial lenders. And at the same time, they're identifying and they're due diligencing businesses that need access to credit, but for various reasons, including lack of collateral, are not able to receive the credit. So if that business goes through and passes our credit review with our field partners and the credit committee approves it, and I'm down now at the orange wedge at 4 p.m., we basically have an approved guarantee. At that point, we issue a letter of credit from Citibank that provides a loan guarantee to the local lender on behalf of that business, basically unlocking that loan from the Southern African commercial lender. And that's right at 6 p.m. at the bottom there. Now, as I'm moving further to the left and going clockwise, the business, that's the borrower, basically uses that loan to grow their activities. They're creating jobs. They're having a positive impact on the community, and they're repaying their loan. Typically, it's a 3 to 5 year period for which they have the loan. When they repay the loan, at that time, simultaneously, our letter of credit matures, and we pay back the principal to our investors, the owners of the promissory notes, and through that time, they've been paid interest as well.
I have one question for you, Casey, going back to the prior slide on the concept that you mentioned of the guarantee potentially being an exit instrument for the impact investors. And I was wondering if you could tell us a little bit more about that.
Yeah, for sure. So some impact investors have, for example, provide a loan for 7 years or 10 years and are looking to redeploy that capital elsewhere when their loan matures. And the business often is not ready to kind of on its own get commercial credit, and a guarantee can actually provide that collateral, provide that assurance for a local lender to allow that business to get a loan, and at the same time allow the other impact investor to redeploy their assets elsewhere.
Right. So that
Let
would fit
me,
with
yeah,
the, oh, sorry, Donna. That would fit with the idea of this being highly catalytic capital. So somebody that is interested in jumpstarting this credit relationships would say, okay, my piece is done here. The creditor, sorry, the debtor can now move to one step up that ladder, and I can redeploy that capital in another community where it's at that earlier stage of the credit cycle, so to speak.
Exactly.
Okay.
Donna, do you have something to add?
yeah, I just wanted to add one thing because a couple of months ago, yes, thanks. A couple of months ago, we began a discussion with one of the major incubators in South Africa. Actually, it's an incubator and accelerator. And what they have found is as they graduate their businesses, after those businesses have had quite a bit of technical support and some initial investments, equity investments, that their program ends and they follow up 18 to 24 months afterwards to see how the graduates are doing. And one of the major hurdles is access to commercial capital for growth, for expansion, for further development of the business. And so both through what we've learned business by business and what we've learned with some of these accelerators is that this is a powerful need. So looking at the particular kinds of transformation that we are applying in this case. The first is beginning to transform the lending practices, and by that I want to add tools and attitudes of local commercial lenders. There are a number of stages of change, and these are what we've observed over the years. The first is, and if you look at whites only apartheid banking, it's not different from the rest of the world, perhaps like the rest of the world, only more so, but nonetheless, a very, very unwelcoming place for low-income, small borrowers of color, particularly if they don't have a credit history, which people did not in South Africa, or if they don't have collateral. So even to get the lenders to consider these folks as a market, as a potential place to lend, takes an enormous amount of time, energy, and the very hard technical work, most often done by our partners on the ground. Then, if you succeed and get the institutions to consider lending to a low-income borrower for a business or a farm, the chances are that the first step in breaking down that wall is going to be to consider this new borrower as an exception. Well, this guy looks okay. Maybe we could lend to him, but we're really not sure about everybody else. It's similar to the way racism breaks down often, where people will say, okay, that family can move in next door, but I'm not sure how many more we want in the neighborhood. So again, attitudes and practices. What we have begun to see, and one of the major drivers of our recent growth, is that the financial institutions, a number of them now, particularly in South Africa and beginning in Mozambique, are beginning to think and get excited about low-income people of color as a potential market, believe it or not. We have had banks who come to us now and have said, excuse us, could you please hurry up your due diligence? The customer is waiting. Now, the fact that they see these borrowers as customers is already a sea change. And the fact that they know that they need to hurry because others may be looking to serve this market means they understand that there is a market and that they had better get on the stick if they want a piece of it. That is where we are now. And they are beginning to do this work systematically, sometimes even with portfolios, as with the use of our guarantees. Now, Andrea, you asked the question, are people likely to get hooked on guarantees? Are they likely to be a buffer between the borrower and the institution? Basically, what I hear you say, distorting the market or making the normal market not particularly workable. The built-in incentive for lenders to do this work without guarantees is that guarantees cost money. Not a lot, but there is a guarantee fee. And so the end game for us, our final objective, is for those banks to say to us, what do we need to pay you a guarantee fee for? These are perfectly good borrowers. this is our ordinary business. This has happened to us already in a number of cases, and we expect it to happen more. The ultimate goal of the guarantee, ours anyway, is to work itself out of business. At the same time, we're very, very conscious that the change, the transformation, needs to happen as well with the borrowers and their communities. These are economically marginalized communities who have been excluded from both economic and traditionally from political power. And that means that they have been denied access to roads, schools, soil, proper soil, decent land, government support, and credit. So the ways that we work with these excluded communities is that there are a number of steps. First of all, these are done through our partner organizations, and sometimes they mobilize additional technical support if it's needed for a particular borrower. First step would be preparing the individual or the institution for credit. So I'm going to use an example here of a microfinance institution that, although in 2004 it had 18,000 borrowers and a 99% repayment rate, could not grow, could not enhance its capital base, could not get a loan. And so the first step, we went to them to help them think about credit, and we said, so just figure out what your normal credit application process would look like, and then we will work with you on how to enhance and apply that process. And they said, loan applicant. I mean, loan, what do you mean by a loan application? Interesting thing, because they had been amazing lenders with a tremendous repayment rate, but had never ventured inside of a bank to look for credit. So we're working and preparing for credit. Then once there is interest by the financial institution, beginning to structure the guarantee agreement, and that with terms that are beneficial and very supportive to the communities and their businesses, but also acceptable to the banks, because we want banks to understand that this is not a philanthropic, but a business proposition. It needs to become their ordinary business. We then work with Citibank to get the letter of credit issued. And once that letter of credit is issued, the local bank unlocks the loan. And that loan then is supported on a continuing basis, in our case, by ongoing technical assistance, training in the business, training in land management, training in business management, training in how to operate a cooperative, and above all, how to manage the credit that they have just taken. So what happens at the end of the loan is that that loan may be renewed, or it may no longer be necessary. In the case of this microfinance institution, after a series of guarantees, the MFI, the microfinance institution, had grown from 18,000 to 140,000 low-income rural women borrowers, and still had a 99% repayment rate. At that point, we went back and said, so will you be looking for an additional guarantee? And the institution said to us, no, thank you. We have just received the promise of an unsecured line of credit. This is a new bank that was not, based on its record, no longer looking for a guarantee. The last dimension of partnership that I want to talk about is the transformative partnership models that turn out to be very, very exciting and provide opportunities for tremendous synergies and innovation. Bear in mind, we're looking at changing a community and all of the systems that impact it. And so we're looking at often many actors and many kinds of support. In Mozambique, in the southern part of Mozambique, we are just now finalizing a deal that will empower 2,500 farmers to create 20,000 jobs. This is not a one institution venture. In fact, the way that this began to develop was a local sugar mill, in a South African sugar mill with operations in Mozambique, was looking to expand its outgrower scheme. The Mozambican government came and said, maybe if you can empower all of the farmers in the region who would be interested in growing sugarcane, you can do a tremendous benefit for the community at the same time as you bolster the business. In that part of the country, and fortunately, those organizations of smallholder farmers are grouped into associations, which they then grouped into one large cooperative, the Luvukani Marime Manika Co-op. That cooperative then was eligible through the farmers to grow cane for the mill. But that wasn't going to be enough because they were located in a floodplain and needed substantial intervention in land preparation, floods, flood control, pumps, drainage system, and also for the off years, irrigation systems. The European Union, with a tremendous grant, came in and made that possible. But the EU would not do this, would not agree to be more than 41.7% of the capitalization of the project. And so where were they going to get the rest of the money to enable them to press the button that said go? And with our help with the guarantee, we were able to bring in Standard Bank of Mozambique for the remainder of the capital, structured as a loan with a 1.5-year grace period. So our work, even more partners involved, because our work was made possible by a grant by the United Methodist Women, who gave us a grant over 3 years, and that's what it took, 3 years to do this deal, and a program-related investment by Ford Foundation. The upshot of this is that by the next growing season, we hope to be on track to benefiting those 2,500 farmers and also strengthening their communities to be more resilient and more able to resist the ravages of climate change. So with that, Casey, let me turn it over to you to talk about sustainable impact.
But thank you, Donna. So the question is, over 22 years since Donna started Shared Interests, what has been the impact? And over that time period, we have deployed $28 million in guarantees. And that $28 million has unlocked $121 million of loans. So that again, that multiple I point to, because typically a guarantee can, and in our case you see it's over 4 times, can provide multiples of financing for the beneficiary. Additionally, we've worked with almost 60 small businesses, agribusinesses, MFIs, and the like, and 18 financial institutions benefiting 2.3 million people. Breaking it down on the next slide to a more granular level, one thing Donna pointed out on the benefits to beneficiaries, I think is important, is 100% of our beneficiaries receive technical support, whether it's assisting to enhance their operational and management systems, or for a lot of the ag groups, we'll partner with other organizations that will provide technical assistance for their agricultural business. As I mentioned, we've worked with 57 different grassroots lenders and businesses, and been fortunate to work with 18 different financial institutions. 2 numbers I'd like to point out here. One, again, is that ratio 1 to 4.3. We have unlocked over 4 times the capital, 4 times for loan capital for each dollar of a guarantee. And again, that's the in my view, one of the most impactful and interesting aspects of loan guarantees. The second number I'd like to point out is investor funds lost. That would be 0%. So that means every dollar that an investor put into our guarantee fund the last 22 years has been repaid with interest, I should add. So looking ahead, where we currently are, and there's a graphic here. You can see our growth in the last the last year in 2016, we've more than doubled the amount of guarantees um, in our portfolio in the last year. We've started working with new lenders, particularly in Mozambique. Our current lenders, and Donna mentioned this, are looking to increase their work with us. And the pipeline of potential beneficiaries is very strong as well. We have approximately um, 4 to 5 million in guarantees in the pipeline that would increase our portfolio. If all of those get issued, um, we'll essentially be at a point um, where we're out of capital, and we're unable to reach our goals. So where we are now is exciting because of our growth, because of the demand, but it's also critical because to reach our goals, um, we're going to need to grow. And so the question is, what are our goals? Basically, over the next 5 years, we want to do a few things. We want to increase the commercial bank's comfort and their capacity to share and more often take on risk. We want to be graduating businesses to be bankable on their own. And ultimately, we want to impact 250,000 low-income Black Southern Africans. So the question is, how do we get there?
And one of the major ways that we are doing this work is, first of all, fundamentally not by itself. The work is inherently a partnership model because we sitting in New York City are in no way equipped to do this without strong partners on the ground. And they, as Casey has mentioned, are a fundamental part of the model. But there are also other kinds of partnerships that we develop over time, and they're catalytic partnerships, often that help us take the major next step in our work. So recently, for example, last year, there was a tremendous commitment by a funding partner, a family foundation. I guess I'm authorized to say the name. It was the Libra Foundation, that agreed to make a three-pronged commitment to this work. They recognized that we were at a takeoff time. They saw the growth, that growth curve had already begun. And they said, you need three different kinds of capital. I mean, in discussions, it emerged that we needed not only money for to guarantee an increasing number of loans, because that demand was coming from the bank. We also needed the money that we raise for our guarantee loss reserve fund. This is a fund of grant dollars that we use to help protect our investors from loss. If there's a call on a guarantee, and we've had some, we dip into the loss reserve first to help protect and maintain the integrity of our investors' capital. And they also made a contribution to operating expenses, recognizing that scaling up our work required increased expenditures and some staff expenses, both in the US and in South Africa. So that kind of a partnership, looking at what is necessary, what is possible, was tremendously instrumental in helping us take that next step towards embracing that large growth curve that you saw in Casey's slide. We are also launching some additional partnerships now, and particularly thought partnerships. As we've mentioned, a lot of our work is in agriculture, and Southern Africa has, guess what, climate change, and in a big way, severe drought. They've just come through the worst drought they've had in more than 30 years, and there's also extreme weather, there is flooding. And so we are not turning our back on the agricultural community, but we are looking for partners in helping us figure out how to assess and address the risk effectively. Because even though we are willing to take that risk, if we are getting banks into this business, it has to be on a basis that they can manage and understand and see that their risks are also mitigated. At the same time, the vehicles that we develop have to be useful to the farmers and supportive of their building a transformative economy at the local level. So we are looking, if anybody is on the phone or knows folks who are interested in that kind of a conversation, and helping to develop the financial mechanisms to make it a reality, we would be thrilled to go ahead with that conversation. With that, I think that pretty much wraps up what Casey and I had planned to present.
Donna, I see a question here from Kate. Um,
Okay. Collective called regenerative finance.
yeah, did you say this is a good question? I'm especially interested in your conversations with financial institutions around issues of racism.
Yes,
How does that
yes.
work?
Well, it absolutely is fundamental, and sometimes it's outright, and sometimes it's a bit under the rug. And where you get a chance to talk about things like that, we had a Black-owned sugarcane cooperative in eastern South Africa a couple of years ago, and the bank said, "Well, we don't think we can do this kind of a loan." And we said to the bank, "But that's very interesting because you have all kinds of loans to white-owned sugarcane cooperatives, not very many miles away, who are in the same sort of community, farming the same kind of soil. What is different, two things are different. One is the color of the people who are doing the work, and secondly is the fact that they don't have the collateral base that perhaps some of the white farmers have." So we took away one excuse. But they still were looking. They said, yes, well, collateral is a problem, and if they weren't able to repay their loans, what would we do? And we then inserted ourselves and said, well, we're actually convinced that this cooperative is quite bankable. We are willing to put our money at risk, and so if you will make this loan, we will share the risk with you. um, it it was in a way a kind of a delicate way of putting in their face that racial barriers are not a reason not to lend, nor are they correlated with bankability, but that if there are historic reasons why people lack credit histories and collateral, let us address those economic realities and change them. It doesn't tend to, so it is not cool in South Africa to be verbally racist. So what often needs to happen is you need to get to the assumptions behind the racism. And at racism, we also experience sexism in a large way. Our major partner organization, the Tembani International Guarantee Fund, is headed by an African woman. And so when she walks into the bank for conversations and negotiations, there were a number of hurdles that she needed to overcome, even though she was armed by our guarantee. And those are worth working through and working past. And with the establishment of some confidence and a history, it is, we have found possible for those institutions to understand a market and an opportunity. But the hurdles are definitely there. The assumptions are definitely there. And hardwired into the banking system is a kind of institutionalized racism that looks at not only factors of what makes somebody bankable, but where they live. People in a township, the same thing we call redlining in our country, has really been developed to an art form in South Africa. So the attitudes as well as the institutional racism are core and need to be dealt with on a continuing basis.
We have a question here from Carrie Hansen. She said, I'd love to hear a little bit more about the process you're using with thought partnerships.
Yeah, and I'm just going to say a little bit about this. We've had thought partnerships on a number of issues over the years, but this particular one is just beginning. We are in conversation with some other lenders that are dealing with, or actually people who are direct lenders, who are working in the agriculture space in Southern Africa, but also looking to work with some universities that have begun to really explore the issue in depth. Our goal is to catalyze a conversation that will develop into looking at both the products that we design and also the approaches, which is why I wanted to put that out on this call, because I know that some of the people in this community are dealing with regenerative agricultural practices, and it would be wonderful to be able to partner with those communities and try and see if there are ways that what we know can strengthen them and vice versa. I just want to say that this conversation, this webinar is extremely well located to be part of the transformative finance conversation, because so much of this work, one is about challenging the assumptions. What kind of society, what kinds of structures are we encouraging and building? And then the second piece of that, I think, is how do we connect the dots? How does each of us bring to the table what we do best to support that shared vision and make it real? So we would very much look forward to working with people on all of those. I've just seen 3 dots, 3 conversations popped up. Carrie Hansen, oops, can hear just fine.
So there's a question from Flora, which is this is a good one. Do we know organizations doing this in Mexico or Latin America?
One organization that has done this work, I don't think they're in Mexico. There is a Swiss-based organization called the International Guarantee Fund, the Fonds International de Garantie. It has an NGO connected to it, which is called RAFAD, which means Research and Applications of Alternative Finance to Development. They're based in Geneva. They have done work in Latin America. I know they've worked in Peru and other countries. Not sure about Mexico, but I can, if you email me, I'm more than happy to connect you to them. I don't know of funds doing this specifically in Latin America. But we'd be happy at least to connect you to the International Guarantee Fund in Switzerland. They might.
Donna, there's a request to take a look at past slides, and because I'm unable to see the slides.
All right. Which slides?
That's a good question. Let's see. Laura, could you, which slides you'd like to see?
Please, Andrea, I have unmuted Laura. She says the last 4 slides.
Hi. Yeah, so I just wanted to take a look. Okay, to the next one.
One more, that one?
Thank you.
And I can send these to you, Laura, if you like.
Yes, please. Thank you so much.
Yep.
Happy to do that. And Andrea will, for other people who might want to see this, go over the details. How will that be available through Transform Finance?
Yeah, anybody that is interested in having the slides, I'm happy to send them out. Or Donna, in case if it's okay with you, I can just send them to the folks that are currently on the line.
Sure.
Of course.
Great. And Donna, did we get to the end of the presentation? I'm sorry, I was again getting kicked off.
Yeah, no, we were. The final slide is for more information on the activities of Transform Finance Investor Network. So that is how people can contact you and get more information.
Wonderful. From my own personal interest, I was wondering if you haven't touched on it already, if you could tell us a little bit about drawbacks of using a loan guarantee model for this kind of development.
Well, I'll start with one, and then Casey can kick in. One drawback is really exhausting, exasperating, and these are. So if you deal with a much smaller lender, they're more nimble, they can make changes. Banks come with a lot of bureaucracy, they come with tremendous institutional inertia, they come with staff turnover, and they come with technical glitches. So all of these things conspire. There have been, some of it you can chalk up to banks aren't used to lending to excluded communities. And some of it is just the difficulty of working with the infrastructure, and particularly with people who are trying to change that infrastructure. So they can be cumbersome and difficult. which is the bad news. The good news is that when they open up and when they decide to make their resources available, the impact can be substantial. One bank that we're working with now is basically blending all around South Africa and making our guarantee product available in provinces totally around South Africa. So once you can establish the mechanism and the partnership, it can be extremely cost effective. In the early stages, it can be quite taxing. So Casey, what would you add to
Yeah, I mean,
reasons not to?
no, but I think in a practical sense, it's tricky to run and grow this business in a low interest rate environment, because the way our model works is one component of earned revenue comes from what are very kind-hearted and generous lenders, our investors essentially, they accept market or below market returns. And the market we're talking about is basically treasury markets. To the extent that they have a minimum threshold that they need to receive as a return, it's very difficult uh, to invest in the high grade securities that we do and get any sort of spread when you're not lending your capital. I think it's tricky.
Two other cautionary notes occur to me. One is that once you do succeed in working with a bank, say you are lucky enough to have achieved a portfolio guarantee, how you structure it is really important to make sure that what the bank puts in the portfolio is something that you would actually like to be guaranteeing. And so there's a lot of work that needs to go into structuring those relationships and those mechanisms. And then finally, and this is part of, very frankly, part of our value add, is that this is not just a guarantee scheme by itself. An essential part of doing it is connecting with grassroots partners and making sure that our technical partners on the ground are providing the information and the support that those businesses and communities need. We are really only as strong as our partners on the ground. And so there are a number of other guarantee funds, multilateral guarantee funds, governmental guarantee funds, that work by simply providing a financial mechanism. For us, because we are about transformation and we are looking to make lasting changes in the way the financial institutions do their business, we consider the technical support key. And it's not just technical support for the borrowers, but also technical support for the lenders, which may or may not be called technical support. But every time one of these agreements is envisioned, shaped, revised, implemented, that is a form of working together with those institutions to come up with a new kind of financial services for a new market.
Thanks, Donna. And I will take, if nobody minds, if there are no other questions right now, one more. As we look at the type of work where the evaluation of the impact centers around job creation, in a context like the United States, we would normally say, well, that's not enough because the creation of low quality jobs actually is part of what keeps people in a cycle of poverty. We really need to be looking at providing credit to entities that provide high quality jobs. And in some other realities, especially where really poverty rates are even higher than they are in the United States, and where unemployment is meaningfully higher. It seems like, however we as an institution might feel about the quality of jobs, the mandate from the local community is really, look, get off your high horse. What we want here is jobs, end of story. How do you see that in the context of Southern Africa and the other geographies where you've worked? Is there a drive towards enhancing the quality of the jobs, or is it really, hey, any kind of credit that will provide any kind of jobs is better than what we have right now?
I think it's a continuum, and it depends which community and where it is in its development process. some communities are just simply happy to get jobs. They could be seasonal, they could be part-time, it could be workers on farms that come and go. And the first step is, but we need to provide options. Communities need some way of sustaining their families. So that's the first step. But as we work with communities for longer periods of time, and as the country itself creates more kinds of opportunities, we are beginning to see in those places where the work has been more systematic, the development of more quality jobs, and not only quality jobs, but quality situations. One of the reasons that we are excited to be working with a number of cooperatives is that people not only, there are a number of benefits, one of which is employment, one of which is improved employment because people have a voice in the kinds of jobs, but people also have a voice in the workplace, how profits are spent, and are receiving the extra income that comes with being one of the owners of the farm. So the initial point may be, could we please just create jobs? Could we please just have more hectares under cultivation? Could we please just provide livelihoods? But over time, that is a base to build on, and it certainly is not the last stop. I think the projects that we are most excited about have a collective component, whether it's a cooperative or a traditional community or a community that is organized in other ways, where people have not only increased economic power, but also use their social capital and begin to exercise their decision-making power in having a say and a stake in the business.
Thank you, Donna. If there are no other questions, I'll turn it over to you for any final remarks you might have. Again,
We're
I'm sorry.
totally used to this, and just appreciate the time to raise this model, these issues, and would really welcome hearing from others who have seen this webinar. Any ideas, thoughts about partnerships, questions. The purpose of this was to begin to catalyze or be part of a continuing conversation. So we look forward to that and greatly, greatly appreciate the work that Transform Finance and all of the supporters are doing.
Well, thank you so much, Donna, and thank you, Casey, for joining us. Again, I'm sorry for the problems on my end. It's always a pleasure to learn more about your work. I find it extremely inspiring and extremely powerful within this context of the tools that can lead to transformation. I will share the slides with the group. If anybody wants to follow up on anything, be happy to put you in touch with Donna and Casey. You can find their information on their website at sharedinterest.org. And my email is andrea@transformfinance.org if you'd like to follow up with me. Thank you so much, everyone.
Thank you.
Thank you.